So this is a recording for Business 3502 Investments, and in this we consider bottom-up financial analysis. As has been mentioned in our workshops and in the coursework, we really have different approaches to stock or security selection, and two different ways could be top-down or bottom-up analysis, or the contrasting is fundamental and value investing compared with momentum and growth. So for now though, we'll start with this tape is on bottom-up analysis, and I'll direct you to, if you see on the screen now, Investopedia.com, which is an interesting source for definitions, analysis, information that is background for security analysis. So our screen right now talks about how bottom-up analysis starts with the fundamentals of the company, from its financial statements, quality of management, service, etc. And it looks for companies that are promising. Now, because we're in Canada, we're going to be worldwide investors, not strictly US investors, so we're able to diversify our portfolios. And something else that we concentrate on in our course, first for modern portfolio theory, is be compensated for the risks you take. And second major message is diversification can help you increase your returns and reduce the riskiness to your portfolio. So we'll look worldwide. So then on our screen we have defensive industries, and there's another fundamental message, whether we agree with it or not, but that's from modern portfolio theory, and it says investors are very, very bad at timing the market. So for a young investor, the advice is start in the markets and stay in the markets. You have a very long investment horizon, and try not to lose. So even though people will are advised not to time the market, people will move from aggressive portfolios to neutral portfolios to what are called defensive portfolios, depending on where they think we are in the business cycle. And we know from our course, we are 10 years on in a very strong bull market in the United States, with on the back of 35 years of declining interest rates. So many people say we're coming to the end of this business cycle. So if we believed that, we would orient our portfolio staying in securities and perhaps moving out of aggressive positions like technologies into defensive positions. So this starts in an Investopedia page, defensive industries. Others that are cyclical or growth industries can balance out portfolios. So perhaps you've been investing for years, you've been in the technology or pharmaceuticals, biogenetics, growth sectors, and you wish to come back to be a bit more defensive if you have a view that we're very far into a business cycle. Okay, so defensive industries, definition of defensive, perhaps consumer basics, consumer staples are defensive industries. Perhaps we consider financials to be defensive industries. So let's then go from this Investopedia to our StockTrack and FinViz screens, and we'll see what we can learn about different industries. So on StockTrack then, resources, one of the resources that StockTrack offers us even before the login page is stock screening. So on this, we could look for different filters, and scrolling down, earnings per share would be fundamental, our value. Change might speak about momentum. Capitalization addresses the size of the company. Then we have things that are metrics, such as price earnings ratios, ratings, sector. Okay, let's drill down onto that. As I mentioned, aggressive portfolios would be strong in technologies, perhaps in financials, perhaps in energy, things that are very more volatile than the basic market through a business cycle. We also see CAPM and beta will tell us about volatility compared to the securities markets. But for now, we could look at financials. So from that sector, where we've chosen financials, we don't much care about volume, but we could look at other things then, earnings per share, etc. Country, any. Okay, this is not quite as advanced or user-friendly as other screens, and there are many other screens, including Investopedia. So let's minimize that and go to another one that's attached also to StockTrack. StockTrack gives us a link to FinViz. FinViz presents a more user-friendly and more complete way to analyze. So starting with this, here's our screen for FinViz. You'll see at the top finviz.com. We can now screen around the world, let's say any exchange. So it gives us worldwide. We could ask for mid-cap companies, so $2 billion to $10 billion range. And this gives us at least 58 screens times 20, so over 1,000 different companies. Earnings date, target price, well, that's not as important as a preliminary screen. Index, any. Dividend yield, well, if we're building a defensive portfolio and using fundamental or bottom-up analysis, we probably would want to see some dividend. So setting a modest screen of 1%, that's cut our selection down by 29. 29 different pages times 20 companies. Volume, don't care for that. Sector, as we've talked about, we're going to look at financials. Float, not particularly important yet. Industry, relative volume, not particularly important. Industry, well, this screen drop-down menu would allow us to select different sectors of the financial industry. But let's leave that fairly open and see what else the screens will tell us. Investment recommendation, well, I do not have a strong opinion for investors. They're usually just glorified salespeople trying to promote something the firm wants you to buy. So that's all we need now as our description. Okay, but let's now take a look at fundamentals. Price to equity, our PE ratio. Classic and extremely important ratio for financial analysis. So let's suggest under 25. Also note, this is the historic price, that's not quite right. Current price divided by historic earnings in the last fiscal year. We are also interested in what's coming for this fiscal year as to be reported. So let's ask for under 20 for the forward price earnings in this year. Price to cash flow, under 5 is quite conservative. Earnings per share growth, we don't need that yet. Debt to equity, perhaps under 1. We're looking at banks and we don't want anything that is over leveraged. Price to free cash flow, under 10 possibly. Sales growth, not too concerned with that. Return on investment, excuse me, I'll leave that quiet. Return on investment, let's look at over 10%. Margin, we don't need to set that right now. Price earnings to growth ratio, again, we don't really need that. And price to sales under 3. It drops us off to nothing. Okay, leaving it at under 5, we have one company listed. Okay, let's check that out. And this is New York Community Bank Corp trading in the United States. Immediately we see on FinViz a chart which tells us it reached a high of 1450 in the March-April period and fell off to 10 in October. That's quite interesting. That suggests a 30% discount from the market high for this company in last March. Okay. Now, as bottom-up investors, we would want to look at all of the things that are presented here. Market cap, we see it's a $5 billion company. Income, $381 million. Price earnings ratio of 13. Keep in mind, the entire S&P's price earnings ratio is 25, so that looks quite positive. Long-term debt to equity is minimal. Earnings per share, moderate. Do we have a dividend yield? We should have yes, dividend 6.4%. Excellent. And that would give us then an idea of, from bottom-up investing, to look at a company that might be attractive. And now we would do much, much more reading and analysis of its actual reports and possibly even have a discussion with the management of the bank. So from bottom up, we set our screens to identify companies that could look attractive. And we leave this very open, starting with a sector and our view for the markets, and then let the screens tell us which ones would be attractive. Note that this aligns with fundamental or value investing, the opposite of momentum and growth, because our stock graph immediately tells us this is not in a momentum and growth stage. In fact, if you're an aggressive investor, this would be a short sale. Fundamental investors would want to analyze to find, is $10.52 below fair market value for this company, in which case we could see it back up to $14.50 and a 40% return on our investment. So an idea then of how we start with bottom up and how that also works well with fundamental and value investing. And we narrow down to specific companies. Okay, well let's open our screen and see if we get a bit more. Here's another one that's interesting. Also notice with our FinViz, we can set for example, return on assets, return on equity, and organize by order. So this one, on return on assets, return on equity, return on investment, ranks better than New York Bank. Okay, let's pursue this one. Oof, what a story. So from 120 down to 40, 2/3 off. Interesting. I have no idea where that took us. Let's go back. No, go away. Okay, so what is this? This is Banco Macro SA, and from Financial Screens, foreign regional banks, and an Argentine-based company. Interesting. Point is, for bottom-up analysis, we ask or set our screens initially wide open, according to our parameters, and bottom up, we look for the security first, then analyze the security, then analyze where it is, for example, countries, foreign exchange risks, and see if we want to put it into our portfolio. Okay, so Banco Macro is also fairly small, 2.6 billion market cap. Income is 300 million on 2.6 billion, so better than the first bank that we saw. Dividend 5.5, comparable. Price earnings is only 8.49, excellent. Forward price earnings 5.3, also outstanding. And return on investment 26%, etc., etc. However, as we see, this is in Argentina. We also then have to consider the country risk for this. So again, bottom up, we find interesting, perhaps mispriced assets. We analyze them to see if they're interesting, and we also do a check on their location and their market. Okay, I do happen to know Argentina is in a currency and liquidity crisis right now. You could read about this as I have. Argentina went to the IMF and organized a standby facility, effectively a line of credit, for $58 billion as a liquidity injection. Why? Because money is pouring out of Argentina, going into the US or European markets, where especially the US, where interest rates are rising. And as money comes out of Argentina, it's caused a liquidity crisis in Argentina. So compounding this, we see Banco Macro has sold off from 120 early this year down to 40. On fundamental and value investing, that makes it very interesting. And if we look, this is a different screen. This is xe.com, which gives us information on foreign currencies. From here we see the Argentine peso has sold off from just under 0.06 to the dollar down to 0.026. So this screen gives us a value of Argentine pesos to US dollars. So it's also in a free fall. Exactly the opposite of what we would want for growth and momentum investing. So bottom up, we look at we set screens and look for things that are interesting, that are possibly mispriced. We check them then against the industry, which would be evaluating price earnings, price to sales, dividend payout, net gross margins, operating margins, net income, etc. And then we also do a check on where it is, for example, Argentina, to see if there's country and foreign exchange risk. So starting from the security, building up a portfolio, checking whether the security would match our criteria for inclusion. And also, as we see in our course, we would want to know if this is adding diversification or reducing diversification. So an example of using our stock screens with a bottom-up approach to investing, which overlays quite a bit with fundamental and value investing. So as we leave, this is one of the companies identified is Banco Macro. It's fallen off by 2/3, which is quite interesting. At the same time, the currency has dropped, so it'll be very, very cheap if we have the courage to invest in a small bank in Argentina. And that also ties into our discussion of our individual or our clients' level of risk aversity. Very interesting.